Hi everyone, and welcome to episode 5 of our series, Securing Your Financial Future. My name is Paul Dell and I'm a partner here at Raffingers, and I'm joined today by Lawrence Daly, one of our consultants at Raffingers Wealth Management. In the last episode, we sort of looked at some basics of IHT, and we're going to follow this up with some more detailed financial products. But first of all, a brief recap on what we covered last time. And what you need to be looking at in terms of some basic IHT planning. So number one, ensure that you have a valid will in place. Very important. The rules of intestacy, if you don't have a valid will, date back 200 years. They're not fit for purpose this day and age. So very important to make sure that you have an up-to-date will in place. Secondly, assess your potential IHT liability. So this can be as simple as just listing your assets and liabilities to see if there is a potential liability. And if there is, which we find most people do have an issue, then make sure you're taking care of the basics. An exemption, 3,000 per annum you can give away, and the normal expenditure out of income rule, which is a very valuable benefit to allow you to give away your surplus income. It's important in that situation to keep accurate records and also to establish a pattern of giving. So again, you need to seek advice if that's something you're looking at. Also consider outright gifts, known as potentially exempt transfers. These tend to be large capital cash gifts. You survive 7 years and the value of the gift falls outside of your estate. And one other thing to consider, once you know the liability or potential liability, then consider some life assurance just to cover the liability itself, which is a simple way, even if it's a short-term planning method, to put other longer-term planning in place. We do find, however, that a number of clients have a few issues around some of these. They don't like giving cash away. They don't know what they're going to live for, etc., etc. They like to keep control of the money. So in those situations, then we can move on to some more sophisticated financial products. And what I'll do now is let Lawrence go through some of those, and I'll be back shortly. So Lawrence, over to you.
Thanks very much, Paul. Yes, I suppose when we're looking here at products and how they fit in with the whole IHT picture, there are two elements which are kind of always fighting against each other, and one is the element of control. Like Paul just said, people are reluctant to give up control of their money. They might be worried about care provision, later life costs that can be quite expensive, especially if you're in the southeast of England, probably looking at least £50,000 a year in care costs right now. So there's this battle between gifting, a 7-year clock, and control. And this is where there's some nice financial products and some nice investments that can come into the picture here. So I'm going to talk briefly today about the two main types of investments or planning which are used for IHT mitigation. And the first one is through the use of what's known as business relief or business property relief. Now, these investments do not leave your estate. So it's when you make the investment, they remain in your estate. However, there's a 2-year clock here, and just like privately held shares, after 2 years, they would drop out of your estate from an inheritance tax calculation under the business property relief rules. So they get 100% IHT relief. Now, these investments, you retain full control over them. So that means if there's a need for care costs later on in life, they can be sold to provide for this. You're not gifting it to anyone and you retain control at all times. And also we're finding nowadays that they're actually quite attractive because they have a lot of features which are becoming more attractive to investors in the current environment. A lot of these investments would have very good ESG credentials. You'll find that generally for the ones where we're investing in a solution in unquoted trading companies, which are run by some of the big outfits out there such as Octopus and Foresight, these companies invest in cash generative businesses that could be in the areas of, let's say, wind power, solar farms, renewable energy, healthcare, fiber broadband is popular as well. So from an ESG perspective, a lot of these investments have very strong credentials as well. They're nothing that will set the world on fire, and they generally tend to return about 3% a year, so just about keeping pace with inflation. But the key element here is for someone who's looking to retain control and is worried about IHT and they have liquid assets, it's a very good solution that provides IHT relief after just 2 years. Now, for those that are looking to have a combination of control and IHT, mitigating IHT, you have a range of options if you go down the trust route. And I suppose, again, the balancing act here is between how much IHT mitigation are you going to get and how much control are you going to get. So the first one that we look at most commonly is known as a loan trust. So in a loan trust, the settler, so that would be the person who is that has the IHT liability, makes a loan of money to the trustees, and the trustees generally invest this in a life insurance bond most typically. So what happens here is that there's a 0% loan that goes between the settler and the trustees, which can be recalled at any time. So if the settler did want to get the money back, they can simply get it back whenever they want. Normally the settler will receive the 5% income, deferred tax income from a life insurance bond, which is over 20 years. That's basically a return of capital. They can defer that and have that cumulatively over a number of years. So what you have here is that any growth on the money that is loaned to the trust is automatically outside of the estate for IHT purposes. And you have a loan here which allows the settler to maintain control if they want to get the money back. From an IHT perspective, of course, if there's an early death here, the loan is not outside of the estate. The loan remains in the estate for inheritance tax purposes. So if you had early death, that wouldn't be the most efficient from an inheritance tax perspective. Now, for those who are looking to potentially put more than the nil rate band into a trust, the most common form of trust that would be used here would be a discounted gift trust. And with a discounted gift, what the settler is doing here is they are making a commitment that they're going to receive the 5% annualized deferred tax payments that for the money that's gifted into the trust. So there's two elements to this. There's the capitalized value, the present value of the future income payments which are going to be received. So that is subject to underwriting, and it would be based on life expectancy and health and everything else that would require underwriting to be formed here. So the capitalized value, that's the discount. Now that's immediately outside of the estate for inheritance tax purposes. And then you have a gift, which is also going into the trust, and that would be subject to the normal 7-year gifting rules for a potentially exempt transfer. In the current environment, with interest rates being where they are, a very significant discount factor can be applied. So that could mean that much more than the nil rate band could potentially be applied to a trust structure like this. So potentially, 500, 600, 700,000 potentially, depending on the life expectancy of the settler in this case. The one thing about these types of structures, however, is that the discount is applied because the settler is making a commitment that they will receive those 5% incomes. It cannot be deferred. So if you have a scenario here where the income isn't required or the income isn't spent, well, then that is building back up in the estate again. So one solution around that is what's called a reversionary trust or a gift and loan trust. And in this type of structure, what we have here is the settler sets up a reversionary interest trust and then gives money into this investment vehicle within it. So this would normally be an investment bond. Typically, however, these types of trusts are structures with multiple policies inside, which is set up by the life insurance company, perhaps 100 bonds. And these bonds would have different maturity dates. So the settler has the option on each anniversary whether they want to receive proceeds of one of those maturing bonds, and they can take this in the form of a maturing life insurance policy. But if they don't need that income, they can then defer that income, and it can roll over to a further period of time. And these types of structures are commonly called a conveyor belt trusts, where you can have a series of income payments which are taken when they're required or deferred when they're not needed. And one of the nice features of this type of structure as well is that while the settler has the option of taking income or return of capital if they want it or not, they can also decide to nominate beneficiaries at any point in time to receive the proceeds of those maturing bonds while this trust is in place. So from an IHT perspective, it's the normal gift rules that would apply here, potentially 7 years. But the one thing that's nice about it is that there is the flexibility there to decide when to receive income, when to defer income, or to nominate beneficiaries if, say, something is required for the purchase of a house or university fees. So as part of the life planning process, it can be quite a flexible product. I suppose the key thing that we're finding out here as we have this discussion is that time is of the essence when it comes to inheritance tax planning. 7 years is typically required for most of these structures where there's gifts involved. The shortest time frame is the 2 years for the investment products. They might not be appropriate for all individuals. They would be considered on the higher risk of investment spectrums due to the nature of the investments involved. So again, it's about mixing and matching what's appropriate for the situation. But the key message to take here is that plan well in advance if you can, because once you plan in advance, the range of options available to you is much more extensive.
Thank you, Lawrence. Excellent stuff. As Lawrence says, guys, the key is to take individual advice tailored to your circumstances. Start planning early, and there are ways that this tax can be mitigated. If you'd like any further information or would like a review of any of your IHT exposure, plans, mitigation options, then talk to your relationship partner at Raffingers, and we'll be pleased to assist. So until next time, bye for now.